The election is just around the corner, and many people are wondering what to do with their money now and after the election. Hi, I'm Bob Powell. Welcome to Decoding Retirement, where we hope to go behind the headlines and help you plan for retirement a little bit better today than you did the day before. This week, we're going behind the headlines with Larry Sprung. He's the founder of Mitlin Financial. Larry, welcome.
Thanks, Bob. Thanks for having me.
It's a pleasure to have you here. It'll be a pleasure to go behind some of the headlines, specifically some of the economic headlines. I know you're a fan of Brian Wesbury from First Trust, as am I. And he, as you know, writes lots of reports about economic headlines. And I want to just jump into some of the things that he wrote about recently and get your reaction. One of them has to do with inflation and retirement. And right now, the current trend in core inflation is that it's stalled at about 2.6%. And what impact is that having on the purchasing power of retirees as well as those saving for retirement? Any impact from your point of view?
Yeah, so the good news is we're at 2.6%, and the bad news is we're at 2.6% because looking backwards, we're far lower than where we were 12 months ago. So that's a huge benefit. But at the same time, inflation has a huge impact on people's purchasing power, and we've definitely seen them impacted over the last several months, if not a couple of years, and people have to plan for if things don't go as planned, that inflation, even at 2.6, may be here for a little longer than they expect.
Yeah. I sometimes think about inflation as a double-edged sword, right? When inflation was low, when we lived in the zero interest rate policy environment, people would say, I'm earning nothing on my money. But on the other hand, they weren't suffering from a loss of purchasing power either at that time. Then we saw interest rates go to 9%. They earned a lot more money, more on their money. They also spent a lot more on groceries, et cetera, et cetera.
I agree with you 100%. And the people that were most impacted over that 20-year period where interest rates were virtually zero and there was no return on, savings accounts and bank accounts were typically retirees, and they were used to much higher returns on those monies, previous to that huge decline in interest rates.
Yeah. So if you're a retiree and maybe you're on limited fixed income, Social Security, maybe a pension, you're withdrawing money from your IRA, what might you suggest in terms of investment strategy? Tips, inflation protected CDs, or what's the option?
Everybody's situation is personal, right? And everybody has a different risk profile in terms of what their ability to take on different risk assets. So there's not really this unisex, Swiss Army knife that you can say this will work for everyone. I really think it's important that everybody have a plan, whether you're retired or, a retiree or moving towards retirement. It's important to understand what those goals and objectives are, what your time horizon is, and what investment vehicles are going to work best for you. Now, we had people looking at that not too long ago as interest rates were rising to put that plan together. Now it's going to be important as we start entering potentially a lower interest rate environment to start putting that game plan and being prepared for that lower rate environment, because those who've gotten used to these higher rates on whatever vehicles, whether it be CDs and tips and things of that nature, they have to start looking and seeing what's going to work best for them from this point forward.
Yeah. And I like to tell people, and be curious for your reaction, that in terms of what they earn on their investments, they should always be looking perhaps to earn a little bit more than the rate of inflation, than CPI, plus whatever taxes, right? What their after-tax rate is minus CPI?
100%. I mean, it's not really what the return is. It's really what do I get to keep when all's said and done. And if your return is, 5%, you then have to take off inflation. You then have to take off what you owe in terms of taxes and see what you're really left with when all's said and done. And if that's a number that you can live with, then that might be an investment that works for you. If it's not, you might have to look elsewhere.
Yeah, so one of the things that we like to do on the show, Larry, is to decode things. And so I think what you've just mentioned is the difference between a real rate of return and a nominal rate of return.
Correct. And they're very, very different.
Yeah, I remember people used to say, I used to earn 19% of my CDs back in the Jimmy Carter years. And I'd say, well, yeah, but inflation was 21%, so you were actually a -3 real return.
Yeah, and I'll share something, that's happened with families that we worked with. They look at some investments out there, and I'm not picking on REITs. They're right, and they're good investments for the right people. But we've had people say to us, hey, I see this REIT and it's paying 8, 9, 10%. And, why are we not allocating funds there? Now, when you look at that 10% yield, it looks looks great, but then when you look at the total return of the investment, if it's gone negative, that 10% may not be what your real return is. And then you factor in those other things, inflation and taxes, and you have to evaluate it with all things being considered.
Yeah, so I'm going to decode REIT for a second, which is
Sure.
real estate investment trust,
Yes.
which are in some cases publicly traded,
Yes.
and in some cases perhaps not.
Right.
Yeah.
Right.
All right, so Brian Wesbury also mentioned that personal income and spending is up 4.5% in the past year. What are the implications of that?
I think personal income is a great determinant about how the economy is going. As personal incomes rise, it's a good indication of where the economy stands. And I think personal income, as long as income continues to rise, that'll keep things strong, because then that will help support consumer spending. And I know, we might also even talk about credit, for example. There's a lot of talk about credit card debt, for example, being at all-time highs. But when you look at it, also personal incomes are also at all-time highs. So maybe it's not as bad a situation as some may paint that to be.
Yeah, we've seen wage growth rise. We've also seen consumer confidence rise, which is certainly good for, I think, the economy in general, if perhaps GDP is, what, 2/3 consumer spending?
Yeah, virtually, that's the main driver of GDP is consumer spending, for sure.
Yeah, so Brian Wesbury also mentioned that consumer spending and fiscal policy issues, he said with government pay and transfer payments rising significantly, how might future fiscal policy adjustments, such as maybe reduced government spending or higher taxes, affect retirees and those saving for retirement?
Yeah, I mean, listen, we're going to have a big shift coming in the next administration, right? We have the Tax Cuts and Jobs Act, which is going to set to sunset at the end of 2025. So we're going to either have to see things go back to the way they were, I believe, in 2017, or some new legislation. So there's certainly some things that we have to be aware of. And retirees, obviously, those especially on some kind of fixed income stream, Social Security makes up the largest portion of most retirees' income stream. If you start looking at taxes on top of that and their ancillary other areas of income, that certainly can have an impact on what they end up taking home each month.
Yeah, I'm curious, if you're a betting man, how do you expect the Tax Cuts and Jobs Act to expire, sunset?
I wish I was a betting man, but I'm not. And I don't think it's going to sunset. I think there'll be some kind of meeting of the minds. I just don't know where that will be. I would like to think that it's not going to stay the way it is today. But at the same time, I don't foresee it going back to where it was back then, even adjusted for inflation. I think it's going to be somewhere in between. But that'll also depend on, what happens with regards to the election, which party gets in as, in terms of the presidency, and which party is in control of Congress. I think those two things will have a big part in what happens next.
So is there any way to plan for that now?
I don't think so, and I don't know that you have to necessarily, because we have the election only a few months away here, and we'll have an idea of where we stand in terms of what party is going to be in charge of each of those branches of government, and they don't expire till the end of 2025. So my expectation is 2025 is going to be an extensive planning year for many people on many different fronts, because of this.
Yeah, so when I talk to my CPA friends, sometimes they say, when we think about the future, that if the one party doesn't control the executive branch and both houses, things are unlikely to change, and either way, right?
I agree with that wholeheartedly, and the markets will show that the markets in general tend to perform better when there is that division of power as well.
Yeah. I should have probably mentioned this earlier when we were talking about personal income rising, but Brian Wesbury also mentions that the savings rate has dropped to around 3%, significantly lower than the pre-COVID levels. Does that have any impact on the world?
I mean, we want people saving. I mean, clearly now, especially those that are entering the workforce now, maybe not necessarily retirees, their retirement is their responsibility. It's not like it was 50 years ago where you worked for a company and had that pension. So looking at that savings rate, it's important. But I would also say that I think COVID threw a real wrinkle into things. And what I mean by that is, over the COVID years, right, people weren't spending during that period of time. And when people got out of COVID, there was almost like this sigh of relief that, oh, you know what, I have to do things and make purchases that I wasn't able to do. So I'm wondering if that ends up reverting back to higher levels like we were pre-COVID in the years to come as we get further away from that COVID pandemic era, if you will.
Right. And as we're taping this show, there's a little bit of worry about an economic downturn. If people aren't saving enough to weather any economic downturn or longer recession than expected or anticipated, they could be putting themselves in harm's way.
Yeah, we're a big fan of having an emergency fund. It's just as important to have that emergency fund as it is to save for your retirement, because most people, if you think about it, are really one major or even a minor event away from not being able to pay for that specific emergency event. So it's important to have that emergency fund and be prepared for a downturn or anything else that might be a large impact to your income stream.
Yeah, so most people suggest 3 to 6 months, but it could depend on circumstances, perhaps.
Yeah, I mean, I think that, depending on your work circumstances, if you're a W-2 employee, that you're in a field that you're, very, somebody who's in demand and can find a new job very quickly, 3 to 6 months is very advisable. Those who may be self-employed, where they'll be in a situation where if there's an economic downturn and it could significantly impact their income and their household, we like to go to, 6 to 12, in some cases even 18 months to make sure that they're insulated.
Yeah. And for retirees, I think, okay, well, you're not in the workforce. It's not like you're going to lose your job. But there are things like new cars and new roofs and new appliances and maybe a grandchild that needs to have a college education paid for or a wedding paid for or something like that.
There's always something. If you want to spend money, there's a way to do that, right? And it's a matter of, even if you're a retiree or entering retirement, it's a matter of being, intentional about it, having a plan. Talk to your advisor if you have one and let them know that my intention is to help my grandkids pay for school or my grandkids for their wedding or whatever the case may be. Have a plan for it so you're prepared for that spend when it takes place.
Right. And it could be that you might need to set aside, 1 or even 2 years maybe of spending to accommodate these unexpected expenses.
Yeah, I mean, hopefully these are not unexpected. Hopefully you're planning for these expenses like a wedding or something of that nature. Really, the emergency fund should be for, loss of a job, roof repair, things of that nature that come out in an emergency situation.
All right. One last question about the housing market. Brian Wesbury mentions that home sales are falling. Existing home sales are expected to decline. And I think about older Americans who want to age in place, but also we're thinking about, how do I use the equity in my home to cover living expenses? Should I downsize? Should I relocate, et cetera, et cetera? Any thoughts about?
It's a challenge. I mean, in certain areas, there is no such thing as downsizing. Where I'm from on Long Island, it's very difficult to go from where you are, where you may not have a mortgage and you're just paying taxes and insurance, to actually downsize and see a significant savings. So it's difficult unless you're going to find a location that you're going to move out of the area where there is going to be a significant reduction in cost. It takes homework. You have to look at that. And I would say, in my view, the housing market has been on a heck of a ride in the last, couple of years. And there's going to be a reversion to the mean at some point, I would imagine, just like anything else.
Yeah. Larry, we have to take a short break, but first I'm going to answer a reader's question, and when we come back, we'll talk more with you about small business owners and also social media influencers who like to talk about money. So a reader asks, I'm looking to buy a long-term care insurance policy. One policy has a reimbursement option and the other an indemnity option. What's the difference between the two? Well, here's the answer. The reimbursement option pays back the policyholder for approved long-term care expenses they have paid during the month, while the indemnity option, the insurance company sends the policyholder a fixed monthly payment no matter how much the care actually costs. So I talked to Scott Olson from the LTC shop about this question, and what he had to say was this, that reimbursement policies are usually less expensive than indemnity policies, and that the only time an indemnity policy is better is if someone wants to use a non-qualified caregiver to provide their care, like a family member or an unlicensed home health aide. Otherwise, most of his clients buy the reimbursement policy. Welcome back to Decoding Retirement. Today I'm talking with Larry Sprung from Mitlin Financial. Larry, one of the things that you're fond of talking about is small business owners and how they can plan for improved financial security. What's on your your list of things that they need to consider?
Yeah, I think small business owners are concentrated very heavily, rightfully so, on their business. It's typically one of their largest assets, and they should be focused there. But there are other things that business owners really should be thinking about in terms of their own retirement, setting up potentially a retirement plan. Whether it's a real small business and it's just them, it might be helpful to their bottom line and tax savings. If they have employees, their employees might be clamoring for the ability to save for retirement. So I think sometimes business owners are super hyper focused, which is great for them and their business, but at the same time, trying to think outside of the box of just what needs to be done for the day-to-day of the business is helpful and could help their retirement as well as the financial future of their employees as well.
Yeah, sometimes these small business owners are chief cook and bottle washer, right? They have to be their own employee benefit and HR department, et cetera. When you think about retirement plans, 401ks, SEP IRAs, et cetera, what?
Yeah, I mean, they've become, it's become much easier to enter the 401k arena. So it really depends on the makeup and the scope of the business itself. What's their employee pool? Are they mainly part-time, full-time? There's a lot of mandates that are coming into place where, depending upon the size of your business and the workforce, chances are you're probably going to have some kind of retirement plan in place in the coming years for your employees. So it's important to get ahead of that and have a conversation with a trusted advisor so you know what you're going to potentially have to do so you can plan for it accordingly in a way that will help you, your employees, and your business.
Right, and there are so many options that people have available to them, right? They could put in place a cash balance plan, for instance, or a defined benefit plan, or other things that maybe help them realize what they're trying to do, which is improve their retirement security, but also maybe retain employees.
Yeah, I'll share a quick story. We had a family that it was a family-owned business, two sisters that were owners. A couple of years ago, they had $1 million in profit, and we were able to set them up with a cash balance plan, basically defer roughly $350,000 into that plan, and we saved them almost $180,000 in tax as a result of setting up that plan. And it's been something that's been in place ever since and continues to give them tremendous tax savings.
Yeah. So what about in terms of a lot of times small business owners, they don't think about it, but they need to think about succession planning.
Succession planning is very, very important. And I think, again, going back to their hyper focus on their business, really the whole idea of the business, even though, most business owners don't want to hear it, when they set out and everything they do within their business should be with the intention of some type of succession down the road, whether it be them selling the business, whether that be a family member taking over the business. But if you wake up each day and run the business with that type of mentality, it's a lot different than running the business in terms of my personal piggy bank or my personal income. And it expands the ability for the business to do even better things. And in the case of a life event where maybe there's a health event or something like that, at least you've been planning for this event for a long time at that point.
Right. And is that even the case for someone who describes their business as a lifestyle business?
Somebody who describes their business as a lifestyle business, if they're going to think that way, then they have to feel comfortable with what the consequences may be if they haven't planned for that succession. And if that's something they're comfortable with, then that might work for them. I don't know that that would work for me.
Yeah. Okay. Let's turn our attention to the world of social media. There are many, I guess they're described as what, finfluencers? Is that the term of art?
Yes, yeah.
Yeah, so there's a lot of them out there
Yes.
on TikTok and Instagram and other places that are sort of espousing something or other about money. How do you help people evaluate who to trust and who not to trust in that world?
Yeah, it's a very difficult thing, and I think when you're scrolling and looking at some of these folks that are giving the advice, you have to be very careful about who you're taking the advice from. We've seen in recent years people giving out and espousing this advice, as you say, and people following it, and 2 weeks later their TikTok handle is gone, evaporated, because the information they gave was wrong or hurtful to those followers. So you have to be careful and look for those individuals or those companies that have credentials. They have, a following behind them, not just a social media following, a following of success in this profession. We get calls all the time. Hey, I saw this on TikTok. Should I do it? And you know what? There are certain things on there that, generally speaking, they're not bad. They're just not right for everyone. And then there are other things that say, we've seen headlines like, you shouldn't put money in a 401k, put it into a whole life insurance policy. I don't think that works for most people, and you have to be careful.
Yeah. So I know, for instance, in my case, I'll use my daughter as an example. Despite all the times that we've ever talked about money, it wasn't until she listened to Mrs. Dow Jones on TikTok that it finally resonated. Now, I think there's, in this case, there's someone that you can trust, perhaps, or at least someone who can get you into the world of talking about money.
Yeah.
Is that helpful in and of itself?
Yeah, I mean, I think it's a way, I have no issue with these platforms. I think they're great platforms, and there are certainly great people that are stirring up conversation, and like with your daughter, getting them to think about things that they not necessarily had thought about before, and that's great. I think where they fail is some of these execution where they say you should be doing this or you should be doing that. I think that's where you really have to understand who you're taking that advice from, who is it really benefiting, and are there other people with greater credentials that you could run it by to see if that makes sense for you before you actually pull the trigger and go ahead and do it.
Yeah, so a similar topic is related to AI, and I've been recently asking AI, Perplexity, ChatGPT, Gemini, personal finance questions, and then asking a subject matter expert to critique those answers, and invariably it gets some stuff right, some stuff wrong, and then there's some serious material omissions. I would never trust AI at the moment with any personal finance question.
Not now. I mean, I've done the same. I've run questions by them to get topics for blog articles and things like that, and I've noticed really a lot, several inaccuracies there. So I think you have to be very careful there as well, and use it as maybe an idea generator, but have a expert or somebody that is a professional double check to make sure that what the AI is telling you can be done, or the way to do it is actually something that would work for you or smart for you to do.
Yeah, and I can tell you from my experience anyway, using Perplexity, there are many others. At least in Perplexity's case, they are sourcing where the information is coming from, so at least I can double check the source, if nothing else. In ChatGPT's case, it's no source.
Yeah,
so
you don't have that benefit with ChatGPT, getting that source. But if you're going to run, I guess, those questions, Perplexity is probably a better option for those types of questions.
All right. So one last question. You're a hockey fan. You're a Rangers fan. I'm a hockey fan. I'm a Bruins fan. You still play hockey. I still play hockey. We're going to have to maybe go on the ice someday and maybe skate together?
Sure. I'm open to it. I love getting out on the ice. We were chatting earlier. Had the opportunity to skate with both my boys this weekend in a 24-hour charity game. I'm a little sore today, but it's a sport that I thoroughly enjoy, and it sounds like you do as well.
Yeah, it's a good sore feeling to have, I think. So, Larry, I want to thank you for sharing your knowledge and wisdom with us today and our viewers. It's so greatly appreciated.
Thanks for having me.
Pleasure. So up next, we're going to answer some questions from our readers in our segment that we call Ask Bob. Up now is Ask Bob, where we answer reader questions. A reader recently asked this, if they need to file the Form 706 estate tax return. And the answer is this: you need to file an estate tax return if the total value of everything the deceased person owned, plus their taxable gifts and any gift tax exemptions they used, is higher than the filing amount or filing limit for the year they passed away. The filing limit for 2024 is $13,610,000, and only 4,000 people had to file that form in 2023. And of the 3 million people who died in 2023, that means the odds of you having to file such a return is 750 to 1. Thanks ever so much for watching Decoding Retirement. If you have a question about money, about retirement, email me at askbob@yahoofinance.com. Stay tuned for more Decoding Retirement in the weeks to come, and also keep watching Yahoo Finance for more retirement news.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.